There are 5 big mistakes that investors make, and I want to share with you today those 5 mistakes and how you can avoid them. All right, number 1 is they try to time the market. Now, if you saw one of my other videos, I talked about dollar cost averaging, which is not timing the market, because nobody has ever been able to successfully time the market and have a big win. Because if that was the case, they'd be sharing the information with you and we would all be millionaires by timing the market. So you can't do that. So just leave your money in there. You have to invest it for the long term, a minimum of 10 years, and you're going to see that money grow substantially. Number 2 is not diversifying. So I have come across a few individuals that have all of their money invested in 1 or 2 stocks. Now listen, that's great if those companies are doing well, but if those companies don't do well, which that can happen, your portfolio will drop drastically and you can lose potentially half of your money. So what you want to do is you want to seek the advice of a professional financial advisor or specialist so that they can diversify your money. Now, you're not going to be getting the 40 to 50% that you could potentially be getting if you had all your money in one stock, but the fact that you will get a 10% return means that the most that you could potentially lose would be a 10 to 20% decline. And so you want to make sure that your funds are diversified, because then you can take advantage of different funds. So what happens is when one fund is doing well, the other may not be doing well. And that's how you diversify and protect your money from market risks. Number 3, chasing hot tips. Okay. By the time you see that this particular fund or this particular company is the hottest company, it's already outperformed everything and it's already made its money. So by the time you see it, it's already too late. So don't worry about the hype. And then, like I said, just seek the advice of a specialist so that you know which concrete funds to actually invest in, the ones that have had the longest performance and the best performance. Number 4, ignoring fees and taxes. Now, with mutual funds and segregated funds, there's always going to be what's called an MER, which is the management expense ratio. So you want to try to invest in funds that have a lower MER. Index funds, which I've said before, do have a very low MER and they mimic the S&P 500. Those funds are a set it and forget it. Now, ones that have a higher MER, so maybe like a 2.8%, you really want to look at the performance of those funds to make sure that it's worth your while. The funds that have a lower MER, like a really low MER, sometimes it's just a money market fund and you're not even going to be getting a return anyways. But you just want to be educated and ask what the MER is on the funds that you are investing in. And number 5 is not having a plan. So if you don't have a plan in place, then you don't know what kind of a return you need in order to be successful and in order to hit your rate of return, especially if you're going to be retiring in the next 10 years. What kind of a return do you need in order to hit your goal? So you want to make sure that you have a plan in place so that you know what goal you need to hit. So I hope that this helps, and I hope that you can avoid these 5 biggest mistakes when investing.